In this episode, we're going to reveal the worst mistakes rentvestors make when it comes to tax depreciation, what you must avoid at all costs when looking at an investment property, and dispel some common myths.
Welcome to Your First Home Buyer Guide, the podcast for first home buyers who want to move it along and become homeowners. But most importantly, it is for you to become an educated home buyer.
I'm Megan and that was Veronica. We're both buyer's agents and probably old enough to be your mum. But it's a good thing because between us we've got over 45 years experience to share with you and bucket loads of stories about avoidable mistakes. Together, we're going to make sure you get unbiased and real information you can rely on. Allow us to guide you on your home buying journey. We want you to become an educated home buyer so that you can stop looking for your first home and actually become a proud homeowner.
We've got loads of great tips for you in this episode, and if you'd like more useful tools, head over to the website homebuyeracademy.com.au, and there you'll get access to our free mini course, How to Price a Property Like a Professional. You will also find the holy grail of home buying education, Your First Home Buyer Guide, the online course for people who want to become educated home buyers. We created this for you to help you get on the right path to home ownership for your first home and beyond.
But before we get into the interesting stuff in this week's episode, we've got the boring bit, the disclaimer. You of course know that nothing in this podcast is to be taken as personal advice. We always recommend getting the advice of an expert in their field who takes the time to understand your personal situation. We've done our very best to ensure that the content is correct at the time of recording. Things change rapidly, so always check with the relevant government authority and your trusted advisors to get the most up-to-date information.
Today we're talking about what seems like a dry topic, tax depreciation, but it is not, especially with our guest expert. Now, getting this stuff wrong could blow up your long-term plans, and that's why you need to stay listening to this absolutely gripping episode. And joining us is Mike Mortlock. He's the MD of MCG Quantity Surveyors. So thanks for joining us, Mike.
Mike, welcome.
What a wind-up. MD, it makes you sound like medical doctor.
That's what came in your bio.
I was leaving that open to interpretation.
I'm the MD. It's good when you're sort of one of the owners of the business, you can make up whatever title you like.
Pretty much.
I'll be head of strategy or chief innovation, whatever.
I've seen titles like chief bun maker and, just really weird titles.
I love it when there's a single person business and they call themselves a CEO. That does crack me up somewhat. But not you,
Yes.
Mike. You're not a single person business and you haven't called yourself a CEO. Do you want to tell us what a quantity surveyor is? Just before, as we kick off, because with our listeners are what?
Yeah, what does he do?
Do tell us, what does a quantity surveyor do?
Well, we are all construction cost estimating experts. So if you can think of any reason why it might be good to know how much something should be built for, then you will need a quantity surveyor. Interestingly, the governments don't tend to use them. They sort of say, like, we're going to build this $2 billion road, and then it becomes $10 billion.
$10 billion.
And I always kind of think,
because they threw a dart at a dartboard.
yeah, I always kind of think, gee, I could have probably helped out there a little bit. But anyway, the phone's not ringing from those guys. But construction cost estimating can be used in a multitude of different ways. It could be feasibility. Say a developer wants to build 3 townhouses and they just want a rough idea of what it's going to cost. And then with the level of documentation, then we can go to, say, tender reviews. We can do progress claims for banks. So if you want to do a development, a bank doesn't just give you the money and say, good luck with it, because then people tend to buy Ferraris and move to Costa Rica. And my area of expertise is on the tax side of things. So I'm glad we're talking about rent vesting for first home buyers, because I think that's a great way to get into the market. And of course, tax depreciation is one of those things that first home buyers kind of think, well, that's just one of the things that investors can do. But if you are an investor because your goal is to get into that place of residence, then depreciation is something you need to understand.
Absolutely.
Now, Mike, I want to circle around a little bit because you and I had a discussion a week or two ago, and I think what we see a lot, and particularly if someone is talking to a financial advisor, or maybe they're having a chat around the water cooler, or they're having a discussion with somebody who considers themselves, a bit experienced in the investment space, they talk about this depreciation. Okay, so they talk about depreciation. We're going to talk about what depreciation is in a moment. But it essentially comes down to sort of a way of decreasing your holding costs in some people's minds. It's much bigger and broader than that. But you told me that there is a question that you are most often asked, and believe me, we're going to roll into why this is a very dangerous thing shortly. But tell us, what is that question as an expert in your field? What is a question that you're most commonly asked? And tell us what your answer is.
Yeah. So because my specialty is tax depreciation and our business does thousands and thousands of these things, of course, we see what people are buying and what sort of deductions that they're getting. And being an expert in the field, they kind of think, all right, what's the best question to ask this guy with a cheap haircut? I'm going to ask him, what's the best type of investment property to purchase for the maximum deductions? And when I answer that question, I used to sort of straight bat it a little bit and say, oh, look, there's reasons why that's not the great question. But I suppose I got tired and sick of that. So I decided I'm going to take the shock and awe tactic. And what I normally will say, okay, the best investment for deductions is going to be an apartment. I would say a 1-bed apartment in a complex of 400 minimum. If we could get, say, 1,200, that would be great. I want as many levels of basement as we can, hopefully 6 lifts worth $1 million each, swimming pools, 1 or 2, indoor, outdoor, we need all of that stuff. Some of these complexes I've seen have a cinema or a library. I'd love to throw one of those in as well. And perhaps even one of those complexes that actually has the common area of your building, but then a common area of multiple buildings. You add all of those things together and the deductions are going to go through the roof. And then it kind of leads people to say, oh, but like from what I've read or from what I've heard possibly Veronica say about apartments, they don't necessarily sound like a good investment. And I go, oh, investment? No, it's a terrible investment. It's horrific. The strata fees will keep you up nights, right? But the deductions, they'll set you to rights.
And that leads me, and I love that because these two things are not, they're mutually exclusive. What gives you the greatest amount of deductions? I'm going to talk about why an investor might consider deductions to be helpful in their holding costs. But what gives you the greatest number of deductions highest level of deductions doesn't necessarily equate to a good investment property, which leads us to, one of the frustrations Veronica and I have, and that is that often financial advisors are somewhat wrapped up or influenced or incentivized by developers, and they're recommending properties that give them the greatest amount of deductions. Tax, accountants, it's their favorite thing to get you the most deductions that you can, but they're not necessarily good investment advisors.
Yeah, and I suppose they might sort of set a goal for themselves is to save people X amount on tax. And you could save them tax by recommending an off-the-plan apartment, for example, but are you maximising their wealth creation by doing that? It's a short-term bonus for something that could cost you 10x or 20x the value of those deductions over time. And you raise an interesting point about when depreciation is used as a marketing tool, it tends only ever to be in off-the-plan sales or brand new property. And I often feel sad for gloss, right? Because people talk about the glossy brochures. Now, gloss is just a coating, right? Like I have no preference for gloss or matte, but gloss gets a bad rap. It's these glossy brochures that have the beautiful stylized designs, and then it will talk about the deductions. And why are they talking about deductions when people don't necessarily talk about it in established properties? It's not because there are no deductions available in established properties. It's just that there might not be much else going on in that property. So as much as depreciation is my specialty and I love it, I would never suggest people buy a property because of the deductions. And I've instead of that long-winded story, I've come up with saying that depreciation is a bonus, never a strategy.
So I was trying to think of a metaphor while you were talking earlier, and I haven't come up with the best one, but the one that I've just come up with that'll work for today
is
it's a little bit like you're on a diet, right? And you want to go and you eat healthy. And while you're walking in the supermarket, you see these low-fat signs for low-fat products. Low-fat products. So you're looking at yogurt, for instance. Now, if you've ever actually, picked up those yogurt tubs and looked at the kilojoules for low-fat and regular fat yogurt, sometimes with the same brand, the low-fat can actually be more kilojoules than the full-fat. And the reason is that they've had to put more sugar in it and starches and other things to actually make up for the fact that fat has flavor, fat has consistency. So, and it's basically looking for the wrong thing. It's really looking at the wrong number and not understanding the big picture. And I think that that's the basic thing. And so you can accidentally buy yourself something that's actually going to make you put on weight instead because you're buying the diet product and it's actually doesn't actually do what it says on the tin. And it's a little bit the same with chasing depreciation. It's like you're chasing tax advantages and you're chasing paying less tax, but what it's not doing is actually helping you in your future for wealth creation, like what you just said, right? So that's my metaphor. It's low-fat yogurt, not always going to help you lose weight. There you go.
That's good.
So
I like that. That actually made me think of another one that's slightly more absurd, which obviously that's...
Slightly more absurd than that.
Yeah. But I'm known for absurdity, I think.
Give it.
Well, I often kind of thought, I know that I can win the Biggest Loser. And people are like, what do you mean? Like, there's people on there that are like 200 or 300 kilos and like, there's no way you could lose that much. And I think, well, yeah, you're probably right. In the 300 kilo stakes, no good. But I kind of thought, what if you went in there at, say, a normal weight and you just cut off your leg, right? You get on the scales, you're missing a leg, you get it done, right? You could actually, if there weren't people too big.
On percentage basis.
You could win.
Right.
You could win.
Yeah.
And you literally cut your leg off despite your face.
Yeah, the unfortunate thing is, as you hop your way out of the studio with your $1 million or I don't know what you get paid, you kind of live the rest of your life with no leg. Now, in the short term, it's like, yeah, okay, well, that's a great idea, but then you are literally sort of legless, not in a good way, forever. So your metaphor, as you might have thought, yeah, that is a bit absurd, but now you've heard
more
mine.
palatable. Yeah, but my metaphor is quite normal by comparison.
Yeah.
There you go.
Right. All right, let's get back on topic here.
Back
now,
on
this
topic.
word keeps coming up. Depreciation. Let's get a
Break
Mike
it down.
Mortlock definition of what depreciation is, how it's used, and some of the pros and cons.
Yeah, look, what it is it's essentially a way to reduce your taxable income. Now, for the purpose of making it fairly simple, let's say, Megan, you purchase a property and you are earning $100,000 a year. If we do a depreciation schedule for your property, and it has to be an investment property, and we find $11,000 worth of deductions, say, now in the eyes of the tax office, instead of earning $100,000 a year, you're earning $89,000 a year. And the difference is roughly $23,000 of tax payable on $100,000 compared to $20,000 on $89,000. So that is probably the simplest way that I've found to explain it. It will reduce your taxable income. And why and how? Well, as an investor, you are providing housing that has a value. It is an investment like any investment that has expenses, right? If you have a business, you have something that you invoice for, something that you sell, and then you've got the cost of doing business, which could be wages, it could be the premises. So the investment game is pretty much the same. The revenue or the invoicing is the rent, and then the expenses will be things like the property management fees, the interest component of your loan, and tax depreciation is an on-paper loss, and it's based on the decline in value of the structure and the fixtures and fittings where they qualify. So the tax office will say, for example, that bricks have a 40-year effective life. That enables us to work out a depreciation percentage. So it all comes off the construction cost, and there's all sorts of boring, nerdy formula that enables me to do what I do. And essentially, people pay me to make those problems go away so they don't have to learn about it.
And you make a good point there, and then that is there's certain elements of the building, the structure, the fixtures, the fittings that have a shelf life, if you like, that has been determined by the Australian Taxation Office. So you just work within those guidelines, as determined by legislation.
Yeah.
Now, we have seen changes to legislation in recent time, and it's actually sort of brought up some or created some myths in the property investment circles, property forums online, and so forth. We're going to get to those myths shortly, but I want to just sort of talk to you about, you've talked about how it reduces your taxable income in a tax year, but it does something to the capital gains tax calculation at the other end. And I think this is one of the big mistakes that we know that investors make, is they don't understand that you might deduct it along the way or decrease your taxable income. But something happens when you sell it too, doesn't it?
Mm. Yeah, that's true. And I suppose it's traditionally been tricky ground for us, because it's almost like we're kind of hiding that there are cons. We talked about pros and cons, but we're not technically really qualified to speak about it. We have to be registered tax agents, but we're very limited in the sort of tax advice that we can give. But it's fairly easy to explain, in the sense of, let's say you have a property that you buy for $1 million, and 2 years later you sell it for $2 million, right? You have $1 million capital gain, and because it's not your principal place of residence, you will have to pay capital gains tax on that. Now, with depreciation, there's two main components. There's the building structure, and then there's the fixtures and fittings, and those are things like ovens and cooktops and carpets and those sorts of things. Normally, there's not going to be anything to speak about from a fixtures and fittings point of view, but the structural component, whatever you claim for that 2 years, will reduce your initial cost base. So the original cost base was $1 million. That's what you bought it for. You sold it for $2 million, so $1 million capital gain. So if we claim, let's say, $20,000 worth of deductions over those 2 years on the structural component, the cost base drops from $1 million to $980,000. So your capital gain will be on the gap between $980,000 and $2 million now. Now, it's a question that often kind of gets heckled at me at the end of presentations, because it'll be all like, oh, it's all very well, this depreciation stuff, but you got to pay it back eventually. So it's kind of like a non-event. I think it's important to understand that it's not sort of robbing Peter to pay Paul. There's quite a few nuances to it. The reason why I picked a 2-year time frame as distinct from, say, a 6-month time frame is that if you own the property for a year or more, you hold it for a year or more, you get a 50% CGT exemption. So now we're not worried about paying tax on the $1 million and $1 million and 20. We're actually looking at half of that. Then it's based on your taxable income. So you take that 50% of the gain, and then you apply your taxable income. So you might only be paying for 45% of half. So it's kind of half and then almost half again. The other thing I think is important to note is that people need to consider the time value of money, and also the period at which it's most difficult to hold a property. So the time value of money is easy because, I mean, we're living in an inflationary environment. We sort of realize yesterday I could afford Weet-Bix, now I can't. Today, $1 is worth more than it will be in 20 years. That's just what happens, right? That's how the world works. The other component to consider is that when you buy an investment property, the hardest time to own it from a cash flow point of view is going to be at the beginning, because over time, your rents will hopefully go up. Certainly, we're living in an inflationary rental environment. And then you may also pay down some principal. So over time, your repayments may drop. They drop in real terms from inflation anyway, but we'll leave that to the side. But your rent will go up. So the most difficult time to hold a property is at the beginning. So that's why we're kind of saying, claim the deductions now, because those dollars mean something to you, rather than worrying about what their value is down the track when you're not having to pay it back. You're paying back half and then your marginal rate of half. That hopefully makes sense.
I think the other thing to be considering is that, so this, like you said, the costs are typically higher when you first buy an investment property. And obviously for a first home buyer who's chosen to rentvest, they've got to be thinking about that, because they're also got to live somewhere else. You've got to either paying rent somewhere else, or maybe you're still with mum and dad thinking, when am I going to get free? Let's go back also to that plant and equipment versus fixtures and fittings, because this is quite important. And this is where the answer to the first question and explaining what is the best property for depreciation purposes, like which property am I going to get the most amount of tax deductions from versus which is the best type of property for me to buy. Two very different questions, but the second question is a better question to ask. But the reason that there's a lot of hype around buying brand new property for first home buyers and for investors is because if you're going to rentvest, if you're going to be an investor and you are claiming your depreciation, you get more depreciation if you can include all of those fixtures and fittings, such as the stove, such as the air conditioning, such as the carpet, such as the curtains, all that sort of stuff. And the problem is, of course, you can only claim them when they're brand new, right?
Yeah.
So even if you buy a 1-year-old property, you can't claim them anymore, which is something that changed back in, was it 2017?
Oh, you've been listening.
I've been listening. I'm an
May,
avid listener.
Good. Give me a date as well.
It was a budget. I can't remember the date.
It was the budget. All right. Well,
17th.
As a bonus question, who was the treasurer?
Morrison.
Yeah, I was going to say head of bushfire response. Yeah, Morrison.
Yes. Oh, he's still. Yeah. Anyway, that's another story. Yes, it was Morrison. Before he became our Prime Minister.
The more I speak, the more Megan seems to be nervous of the direction this show is going.
Where are we going with this? We don't get political. No.
You're right.
And don't set Veronica off, because if we go down that pathway, we'll just have to cut it out.
We'll have to edit. Yeah, we don't want to edit. We want to go straight to publish. Anyway.
The 9th of May, you're absolutely right. So from that time on, and it was literally from 7:30 on the 9th of May, because that's the exact time the budget speech started. It's quite peculiar the way they do that. If you exchanged on a property from that day onwards, it either needs to be a brand new property, or you could buy an established property and put brand new assets in. So you could put brand new carpet in and then just have the carpet to claim. So yeah, either buy brand new or put brand new assets in. One thing that a lot of people don't realize as well is that people will kind of say, all right, well, if I buy a brand new property, it doesn't matter, like those 9th of May rules don't actually apply to me. But that's not technically correct. If you buy a brand new property and then let's say you rent it out for a year and then you live in it, from the moment that you occupy that property, you will actually forever kill off those plant and equipment deductions. Whereas with the old system, you used to be able to come in and out and it wouldn't have any impact. You just wouldn't claim the deductions for that period of time where you lived in it.
That could be a trap. You could imagine that there could be some first home buyers wanting to get the first home buyer grant, so living in it for 6 months or whatever, but then actually foregoing the depreciation because they've done that. So you take with one hand and you give with the other. But we're not recommending you go and buy brand new anyway, so it doesn't really matter. But
well, it's one of the myths, and I think that's point 3 that we do want to cover off. One of the myths is that to get any level of depreciation that you can claim and get any tax benefits, it has to be brand new. But Mike, that's not actually the case.
It's 100% wrong. In fact, I've even heard some of my quantity surveying brethren say that new property is always better for depreciation. And I can give an instant example where it's not the case. So let's say a brand new project home, maybe it's built for $400,000. The deductions could be $15,000 or $20,000 in the first year. But let's say a property that was built in the 1920s in, let's say, trying to think of a blue chip suburb, maybe like Bondi.
Very blue chip.
Yeah. So it could be a rather large property built in the 1920s. Maybe it was purchased for $5 million because a year ago it's had a $3 million renovation on it. Now, let's say maybe only $2 million of that is structural components. You're getting 2.5% worth of that value each financial year. So what we're talking, $50,000 a year worth of deductions as distinct from 15 or 20. So to say that new is always better is incorrect. Now, that example is a bit unusual. You're not sort of tossing up, do I get a project home or do I get a $5 million place?
But not where most of our audience are. That's okay. It's a good example.
Of course, I caution people against any sort of blanket statements like new always better or old is no deductions. And that's kind of just my way of illustrating it. Of course, new property typically will be better for depreciation deductions. But what people don't realise is that the cutoff date for depreciation claims on the original building structure is 1987. Now, we find about, last time I crunched it, was 69.9% of all properties that we do are built after 1987. And the ones that are built prior to 1987, it's more than 2/3 of them have had renovations. And that's an important consideration because let's say the property was built in the 50s and it's a more modest, typical first home buyer style property. If it's had a kitchen or bathroom renovation or any sort of extension or a new carport or driveway or retaining walls, as qualified quantity surveyors and construction estimators, we're qualified to estimate the value of those works, even if they're done by the previous owner. So people might say, well, I don't have any of those costs. Well, that's where we come in. We're recognised by the tax office as being able to estimate them. So New typically will be better, but to say that there's no depreciation is a bit of a furphy.
I've always been able to claim depreciation, and I don't buy new properties, so absolutely correct.
Yep.
And one of the things you do is obviously get a depreciation schedule put together for you by a quantity surveyor, such as Mike and Mike's business. Because then when you do lodge your tax return, you need to include that. Another thing that probably we could talk about is one of the things that you mentioned earlier about government infrastructure and a road that might have been, announced at costing $2 billion and ends up, really costing 10 because somehow they don't seem to use quantity surveyors.
Yeah.
But when you're trying to insure your property, now, if you're going to buy an apartment or a townhouse or a villa, you don't have to worry about insuring it because the strata management or the owner's corporation insures the whole building. But if you buy a house as an investment, you need to make sure that you're insuring it for the right amount of money, so that you're not underinsured. And that is something that I think is quite interesting as well in terms of what quantity surveyors can do and work out really what the replacement cost of that building is. Recently I've got an investment property that's a house, and the insurance, in fact, I need to get you guys through, Mike, because the insurance company, I rang them and said, look, I think it's underinsured, and they gave me this tiny figure to build. Basically, they gave me $460,000 or something to build a 2-bedroom brick semi-detached 1920s or rebuild a 1920s bungalow in inner Sydney. And I went, 400 what? And they said, yes, that's our schedule. And I'm like, that's just ridiculous, So I was worried about being underinsured. I went to the insurance company and they told me that, which was a lot less than what I already had it insured for.
Yeah.
So do you want to explain, I guess, how people work out what they should, and in fact, this goes for whether you're buying for an investment or not, actually.
Yeah. Oh, absolutely, it does. I think it's important both ways. And when it comes to the strata, you're correct, is that the insurance will be taken out by the strata, but I think it's also incumbent on owners to investigate whether the value is appropriate as well.
True.
Just because there's
That's true.
a strata company in the mix doesn't mean that they've had an independent expert. And there's an ongoing kind of debate that we're having with valuers that are putting replacement cost values as an addendum to their market valuations, and they're not qualified to estimate construction values. And many of them will say, we use Cordell's construction calculator and it's industry standard, and insurance companies use that, but it also itself has a disclaimer saying you need to use a quantity surveyor to be able to rely on this, right? So it's kind of like we're arguing round and round in circles to an obvious point.
It sounds a little bit like using an AVM or an automated valuation model rather than actually getting a valuation. So they're two different things. Okay, so yes, do explain.
The big problem is that we saw last year in 2022, or this is sort of an awkward timing thing. Anyway, we'll just say 2022, construction costs went up 11.9%, which was really the highest on record. Ostensibly, there was an issue with the GST and around 2000, but that's the highest on record. And we saw 16 straight quarters of construction cost growth. Now, if you think back to pre-COVID, where the construction costs really started to soar, the Insurance Council of Australia said that 83% of properties are underinsured. So 83% before construction costs went through the roof. We're talking, 20% in 18 months or thereabouts. So it's a huge problem in Australia, and people don't necessarily realise what a replacement cost is. I can remember as a student being guilty, and I'm happy to share it. When I was sitting at home in the first property that I ever bought, I saw an ad for one of those glossy home builders, right? And, it was sort of like, build this place and it's, $250,000. I'm like, wow, that's way nicer than my place. I guess I'll just insure mine for $250,000 and I'll get that. Like, most naive thing ever to think. Because the reality is that the cost to rebuild your property is not the cost of a builder going and building on a brand new site. There will be demolition works. It may be too close to the boundary. It might not be allowable to build in the same type. The materials might not be feasible to build in. There's also cost escalations with the tendering period. There's all sorts of nuances in and around the construction cost that people don't realize. It's not just go and get something built. There's a lot more to that. So I feel for the consumer, because what we've got is insurance companies with their online calculators. The people that are using commercial insurance brokers to help with their insurance are tending to use people like quantity surveyors to make sure that they've got an adequate insurance policy in type and level of cover. But for the consumer, it's a real minefield. But it's certainly something that we can do to help homeowners, whether they're investors or owner-occupiers.
I'm going to briefly touch on, but we won't go into it too much here. But the other thing that you there's a number of things that you get involved in as a quantity surveyor. People who are buying strata or a townhouse unit, anything with a body corporate or strata.
Yeah.
We always suggest that when they're doing their record inspections, that they look at the capital works forecast.
Yeah.
And compare that to where the sinking fund or capital works fund is sitting. That's something that your profession prepares for a body corporate or a strata management company or strata.
Yep.
But it's not something that an individual would engage you for. Can you just very briefly talk about what that capital works forecast is and why it's important for a buyer of an individual lot to be at least somewhat aware of what it is?
Yeah, look, and I think if you're using a solicitor or a conveyancer, they can be doing the strata reports where they're investigating that and much, much more. But essentially what happens is that the buildings, they wear out. It's not like people are necessarily hard on them. Just over time, things need to be maintained, things need to be replaced. So there has to be an adequate budget to be able to cover those improvements. And typically people have called it a sinking fund, but the new terminology, as you say, is capital works fund. So what we do is we look at all of the building components. We assign essentially some life cycle costing to the individual widgets within a building, and then that will kind of forecast, all right, in this particular year, we're looking like we need a roof replacement or a gutter replacement, or these railings need to be redone, or we've got to repaint. So these are all things that are kind of forecast, and then you can back calculate, well, what is the appropriate strata fees that will ensure that we have coverage for these additional works? Because the reality is if you don't do that, eventually you will end up with special levies, which can be, you could find yourself in a position where you just don't actually have the cash to meet that special levy, and it can also make the property less desirable for investors or new owners that are looking to purchase in that block when they know, well, no one has really been prudent with this particular fund and there will be future costs that are going to have to come out of my pocket, and that can affect your value.
Absolutely. And, we teach you what to look for in a strata report in your first home buyer guide. But it's funny, the other day I was, because I run a mentoring program for new buyers agents as well, and we were talking about strata reports, and I was talking about the capital works fund forecast, the sinking fund forecast, and there's a difference between the ones that strata managers can buy off a shelf versus ones that they've actually had a quantity surveyor go to the actual complex or building and look at the actual roof and look at the actual lift and look at the actual walls and so on, as opposed to using one of those calculators and sort of plugged in that, the roof's 40 years and the building's this and that. How do you tell, because this is a question that was asked to me and I don't know the answer, how can you tell whether the Capital Works Fund forecast has been put together by a quantity surveyor who's actually inspected that exact building, or it's done via one of these calculators?
Yeah, well,
Is there a way?
Yeah, I mean, we could tell. I'm just trying to think about ways that are easy for the consumer. Like normally the level of breakdown is the biggest giveaway. When you see the policies, the insurance policies and things like that, you will normally see, well, where has the valuation come from? Is the replacement value something that a valuer has done or a quantity surveyor? And I don't mean to knock valuers too hard. I've got lots of friends that are valuers and they're very, very good at providing market values, so much so that our institute says that we're not qualified to do it. I would argue by the same case, they are not nuts and bolts construction cost experts. So the easiest way for me is to see, is this a sinking fund that was done by a valuer or a quantity surveyor? And it really should also have the date of the inspection on that report as well. Unfortunately, the industry has really had a little bit of a race to the bottom from a cost point of view, and there have been a lot of valuers active in that space to the point where it's a service that we essentially have parked. We don't necessarily advertise it that much because to do it properly, we're going to be more expensive than they'll be able to get it. We're working on some innovation to try and meet the markets to some degree because there are people that have an appetite for, like, I actually want this to be correct. I want this to be right. We've got some great strata managers out there, but it's difficult when you've just got these tick and flick style reports, and the net result is you're ending up being exposed. Like sometimes it's worthwhile paying a little bit of money for peace of mind. It's no different to things like education.
Yeah. It's interesting, isn't it?
Mike, that has been awesome. You've talked to us about some of the worst mistakes that you hear investors make when it comes to investing in relation to tax benefits. And you've also shared some of those examples of things to avoid, but also dispelled some common myths that are out there. So thank you for that. We always have one last question of our guests, and that is, what is one thing that you know now that you wish you knew when you were buying your first home?
I did see, you would expect that I'd have a better answer because I did see this in advance, right? And I just kind of thought, gee, I don't really know. But the best I could really come up with is that when I first bought my home, I was so terrified about every economic development. I was so terrified about whether it's going up or down. And as human beings, we tend to look at things as being hyper important in the moment. But then when you zoom out to a macro view, that huge crash or that huge boom is this tiny little dot in time. So I wish that I understood the value of time and patience as a property owner. And I think that would have reduced a few of those grey hairs that I have to keep at bay with a number one buzz cut.
That's great. It's it's not about timing the market, it's about time in the market.
Yes, That's one of those old adages that is true.
Yeah.
As opposed to so many others that are not true. Just a quick note for our listeners, this course that we offer, which is called Your First Home Buyer Guide, it only costs $990, and you get direct access to Megan and myself to help guide you through your negotiations even. Trust me, you'll overpay a hell of a lot more than $1,000 if you don't know what you're doing. So we just encourage you to jump on the website, homebuyacademy.com.au, and have a look at the course and see whether or not it's something you want to do. We encourage you to do so.
In this episode, we've only touched on a tiny part of the huge amount of things you need to know to become an educated first home buyer. There is so much more for you to do. You can learn all of the steps in the right order and avoid all of the mistakes that others have made in our 10-step online course for first home buyers.
If you'd like to learn more about the right process and avoid making rookie errors, become an educated home buyer. Head over to the website, check out Your First Home Buyer Guide, the course that we have created for you. And don't forget to subscribe to the podcast so you won't miss an episode. And if you've liked what you've heard today, please give us an iTunes review. It helps other people find us. And of course, I know it's a bit cringy, but we're going to ask for 5 stars. Thank you.
Thanks for joining us. We hope you found this really useful. And if you have, please share the love with others who you know are in the same boat. We'll be back next week with more priceless stuff.